Most people think the biggest opportunity in a new industry is the company everyone is already talking about. But history often suggests the opposite. The more attention a single company gets, the more the real story shifts quietly into everything built around it. That tension is starting to show up again in the conversation around SpaceX. On the surface, the excitement makes sense. A company that has redefined launch costs, dominates commercial space access, and operates a global satellite network naturally attracts attention. When a business like that moves closer to a public listing, it feels like a rare moment, something people don't want to miss. But that instinct can be misleading, because when markets focus too narrowly on one name, they often miss the structure forming underneath it. The common belief is simple. If a major space company eventually becomes public, that is where the opportunity begins. People assume the value is concentrated in the headline. The logic feels intuitive. The leader must capture the majority of the returns. Yet, this way of thinking ignores how industries actually grow. No complex system is built by a single company, especially not one as capital-intensive, uncertain, and long-term as space infrastructure. What looks like a single story is often a network. Launch providers, satellite operators, data companies, communications platforms, and manufacturing systems all depend on each other. The real shift is not just one company becoming investable, it is an entire ecosystem becoming visible. And that changes how the situation should be understood. For decades, space was largely driven by governments. Budgets came from public spending. Objectives were political, scientific, or strategic. Profit was not the primary goal. That structure limited participation. Now that model is changing. Across multiple countries, there has been a steady transition toward private involvement. Regulations have evolved. Capital has followed. And companies are beginning to treat space not just as exploration, but as infrastructure. That distinction matters. Infrastructure industries behave differently from speculative ones. They build slowly. They require large upfront investment. And once established, they tend to create long-term recurring demand. This is where the perspective begins to shift. The real story is not about a single IPO. It is about whether space is moving from an experimental phase into an operational one. If that transition is real, then the implications extend far beyond one company. One of the most consistent patterns in business is that the largest returns rarely come from the most obvious entry point. Instead, they come from understanding how value flows through a system. In railroads, it was not only the rail operators that mattered, but also the steel producers, the equipment makers, and the businesses that relied on transportation. In the early days of the Internet, it was not just the platforms, but also the infrastructure providers, the hardware companies, and the service layers that followed. The same logic may apply here. When a dominant launch provider reduces the cost of reaching orbit, it does not only benefit itself. It lowers the barrier for every company that needs access to space. That creates demand, and demand creates entire categories of businesses. Some focus on launching satellites. Others focus on what those satellites do once they are in orbit. Some are building communication networks. Others are building imaging systems. And some are working on the physical infrastructure that may support activity beyond Earth. Individually, many of these companies are still early. Some are not yet profitable. Some are still proving their technology. That introduces uncertainty. But collectively, they represent something more important. They represent the early stages of an ecosystem forming. A more grounded way to look at this is to separate narrative from economics. The narrative is easy to see. It is driven by ambition, missions to the moon, plans for Mars, global connectivity. These ideas capture attention because they are large and easy to visualize. The economics are quieter. They are found in contracts, backlogs, service agreements, and incremental improvements in cost and reliability. They are found in the pace of launches, the growth of satellite networks, and the expansion of commercial use cases. That is where long-term value tends to emerge. One of the most disciplined approaches to investing has always been to focus on what can be measured over time, rather than what can be imagined in the moment. Not because imagination is unimportant, but because markets often price imagination very quickly. Execution, on the other hand, takes longer. And that gap between expectation and execution is where risk and opportunity both exist. In the case of space, execution is still unfolding. Launch frequency is increasing, but it remains constrained. Satellite networks are expanding, but many are not fully monetized yet. Infrastructure projects are being planned, but most are years away from completion. This creates a situation where expectations can run ahead of reality. And that is where discipline becomes important. A useful principle here is to think in terms of dependencies. Instead of asking which company will dominate, a better question might be, which parts of the system are essential regardless of who leads? For example, if access to space becomes cheaper and more frequent, then demand for launches increases, but so does demand for satellites, and data, and communication services, and maintenance. Each layer depends on the others. This creates multiple points where value can accumulate. Another principle is to pay attention to time horizons. Some businesses in this space are closer to generating stable revenue. Others are still in a heavy investment phase. The difference between the two is not just risk, but timing. Companies that are already generating revenue from services may behave differently from those still building capacity. The former may offer more stability, the latter may offer more uncertainty, but also more sensitivity to future growth. Neither is inherently better, but they should not be viewed the same way. There is also a tendency to assume that once a major event happens, such as a high-profile IPO, the outcome is immediate. That prices will move in a straight line, that demand will translate directly into returns. In reality, markets rarely move that cleanly. High-profile events often bring attention, and attention can drive short-term volatility. Prices may rise quickly, but they can also adjust just as quickly when expectations shift. This is especially true in sectors that are still developing. Early-stage industries tend to move in cycles. Optimism builds, capital flows in, projects accelerate, then reality sets in. Timelines stretch, costs increase, and prices adjust. Over time, the stronger businesses continue to build. The weaker ones fade, and the industry gradually stabilizes. Understanding that cycle can help reduce the urge to react to short-term movements. because the long-term story, if it plays out, will not depend on a single moment. It will depend on whether the underlying system continues to expand and whether the companies within it can execute consistently over time. To understand how this ecosystem might evolve, it helps to look at how value is currently being created inside it. At the center is access. The ability to reach orbit reliably and at lower cost changes everything. It is similar to how cheaper transportation reshaped trade, or how faster internet reshaped communication. When the cost of access drops, new use cases begin to appear. That is already happening. Satellite launches are no longer rare events. They are becoming routine. Constellations are being built, not just single satellites. And instead of serving only governments, these systems are increasingly designed for commercial applications. But access alone is not the end product. It is only the first step. Once objects are in orbit, the question becomes, what do they actually do? This is where the next layer of the system starts to matter. Some companies are focused on communication. The idea is simple but powerful. If a network of satellites can provide consistent coverage, then connectivity is no longer limited by geography. Remote areas, oceans, and regions without traditional infrastructure can all become part of the same network. That concept has clear potential, but it also comes with challenges. Building and maintaining a global satellite network requires continuous investment. Satellites have limited lifespans, launch schedules must be maintained, and competition is increasing as more companies attempt similar approaches. Execution again becomes the deciding factor. Another group of companies focuses on data. Earth observation is one of the more immediate commercial applications of space technology. Satellites can capture images, track environmental changes, monitor infrastructure, and provide information that is difficult to obtain from the ground. The demand for this kind of data is growing. Governments use it, businesses use it, even financial institutions use it to gain insights into economic activity. But the challenge is not collecting data. It is turning that data into something valuable. Raw images are only useful if they can be processed, analyzed, and delivered in a way that solves real problems. That requires software analytics and integration with existing systems. In other words, the value shifts from hardware to interpretation. There is also a third layer that receives less attention but may become more important over time: infrastructure. If activity in space continues to expand, then infrastructure will need to follow. This includes not only satellites, but also the systems that support them, manufacturing capabilities, structural components, energy systems, and potentially even facilities beyond Earth. These ideas may seem distant, but early versions of them are already being developed. And like most infrastructure projects, they are capital-intensive and slow to scale. This is where patience becomes essential. One of the most common mistakes in emerging industries is assuming that early progress guarantees near-term results. In reality, progress often comes in uneven steps. Periods of rapid development are followed by periods of consolidation. Companies invest heavily before they generate returns. And during that time, they rely on external funding contracts or partnerships to sustain operations. This introduces a different type of risk, not just whether the technology works, but whether the company can manage its resources long enough to reach profitability. Some businesses in this space are already generating revenue through contracts and services. Others are still in a phase where expenses exceed income. Both situations are normal in an industry like this, but they require different expectations. A business with steady contracts and growing revenue may be building a foundation. A business with high expenses and uncertain timelines may be building potential. The difference between the two is not always obvious in the short term. Markets often react to signals rather than outcomes. Announcements, projections, and expectations can drive prices before results are fully realized. This is why volatility tends to be higher in sectors like this. Prices move not only on what is happening, but on what might happen. That creates both opportunity and confusion. It is easy to get caught in the movement, to focus on short-term changes and assume they reflect long-term value. But in many cases, they reflect sentiment, and sentiment can change quickly. A more stable approach is to look for patterns that persist over time. For example, is demand increasing? Are contracts becoming more consistent? Is the technology being adopted in practical ways? Are costs improving? These are slower signals, but they are more reliable. Another useful way to think about this is to consider how industries mature. In the early stages, many companies enter the market. Each one tries a different approach. Some focus on innovation, others focus on scale. Some prioritize speed, others prioritize efficiency. Over time, the market begins to filter these approaches. Companies that cannot sustain their model either adapt or exit. Those that can continue to build. Gradually, the industry becomes more structured. Leaders emerge, standards develop, and the focus shifts from possibility to performance. Space may still be in the earlier part of that process, which means uncertainty is not a flaw in the system. It is part of it. But it also means that expectations need to be grounded. It is tempting to assume that a major event like a widely anticipated public listing will accelerate everything immediately. That capital will flow in and the entire sector will rise together. That may happen in the short term, but over the longer term, outcomes tend to diverge. Some companies will execute well, others will struggle, some will reach profitability, others may not. And the differences between them will become more visible over time. This is where careful thinking matters more than quick decisions. One of the most consistent investors in history tends to avoid complexity, not by ignoring it, but by simplifying it into clear questions. Does the business solve a real problem? Can it deliver that solution consistently? And can it sustain itself financially while doing so? These questions apply here as much as they do anywhere else. And they help shift the focus away from headlines and toward fundamentals. Because in the end, industries are not built by announcements. They are built by execution over long periods of time. To make this more concrete, it helps to step back and look at how similar moments have played out before. When a new industry begins to take shape, there is usually a phase where one company becomes the symbol of that change. It attracts attention, capital, and expectations. It represents the future in a way that is easy to understand. But behind that symbol, a quieter process is happening. In the early days of commercial aviation, the focus was on the airlines. But over time, value also accumulated in aircraft manufacturing, maintenance services, logistics systems, and airport infrastructure. The visible layer was only part of the system. A similar pattern appeared in the growth of the Internet. The first wave of attention focused on platforms. But over time, the underlying infrastructure, data centers, networking equipment, cloud services became just as important. The pattern is consistent. A breakthrough at the top of the system tends to create pressure and opportunity across every layer beneath it. If that logic holds, then the current moment in space is less about a single event and more about a broader transition. The increasing pace of launches suggests that access is improving. The expansion of satellite networks suggests that applications are emerging, and the growing number of companies involved suggests that the ecosystem is deepening. But none of this guarantees outcomes, and that is where the risk side of the equation becomes critical. First, there is execution risk. Many of these businesses are attempting things that have never been done at scale. Even when the technology works in controlled conditions, scaling it reliably is a different challenge. Delays are common. Costs can increase. Timelines can shift. When expectations are high, even small setbacks can have an outsized impact. Second, there is financial risk. Building in this space requires significant capital. Companies may need to raise funds multiple times before reaching profitability. If market conditions change, access to capital can become more difficult. This creates a dependency that is not always visible in optimistic scenarios. Third, there is competitive risk. As the opportunity becomes more visible, more companies enter the space. Some bring new technology. Others bring different business models. Over time, competition can compress margins and challenge early assumptions. Being early does not always mean being dominant. Fourth, there is macro uncertainty. Space may feel like a separate domain, but it is still influenced by broader economic conditions. Interest rates, geopolitical stability, and government policy all play a role. Contracts can be delayed. Funding priorities can shift. These factors are difficult to predict, but they cannot be ignored. Taken together, these risks do not invalidate the long-term potential, but they do shape how that potential should be viewed. A balanced perspective recognizes both sides. On one hand, the structural shift toward commercial space activity appears real. The demand for connectivity, data, and infrastructure is growing. The cost of access is improving, and the number of participants is increasing. On the other hand, the path from early growth to stable profitability is uncertain. It may take longer than expected. It may involve setbacks, and it will likely reward only a subset of participants. This leads to a more grounded takeaway. The most important question is not whether a single event will create opportunity. It is whether the underlying system continues to develop in a sustainable way. If it does, then value will emerge across multiple layers of that system, not all at once and not evenly, but gradually. If it does not, then even the most promising narratives may struggle to translate into lasting results. A useful mental model here is to think in terms of durability. Which parts of this system are likely to remain necessary regardless of short-term changes? access to orbit, communication networks, data processing, infrastructure support. These are not trends. They are functions, and functions tend to persist even as individual companies change. Focusing on functions rather than stories can help reduce noise, because stories evolve quickly, functions evolve slowly, and long-term outcomes are usually driven by what changes slowly. In practical terms, this means stepping back from the immediate excitement and asking more fundamental questions. Is the industry solving problems that matter? Are customers willing to pay for those solutions? And can the businesses providing them operate in a way that eventually becomes sustainable? These are not exciting questions, but they are useful ones. They shift the focus from speculation to reasoning. And over time, reasoning tends to be more reliable. The broader takeaway is simple, but not always easy to apply. When attention concentrates on a single company, it often creates the illusion that the opportunity is concentrated there as well. But in complex systems, value is usually distributed. Understanding how that value flows requires patience, discipline, and a willingness to look beyond the obvious. That does not mean ignoring major events. They can signal important changes, but it does mean placing them in context, because the real story is rarely about a single moment. It is about the structure that develops over time, and whether that structure proves strong enough to support the expectations placed on it. If you found this perspective useful, consider taking a step back the next time a major headline dominates the conversation. The goal is not to react faster, but to think more clearly about what is actually changing beneath the surface. Clarity, in moments like this, often comes from remembering what tends to endure. Markets change quickly. Narratives shift even faster, but the underlying drivers of value tend to move at a slower pace. They are tied to real demand, real constraints, and real execution. In the case of space, the long-term direction appears to be shaped by a few simple forces. The need for connectivity is not going away. If anything, it continues to expand. More devices, more data, and more reliance on constant access all point in the same direction. The need for information is also growing. Businesses, governments, and institutions are making decisions based on data, and some of that data can only be collected from above. And the need for infrastructure tends to follow both. If connectivity and data continue to expand, then the systems that support them will need to expand as well. That includes satellites, launch capacity, and the physical structures that make the entire system function. These are not short-term trends. They are structural. But structural does not mean simple. Each of these areas comes with its own challenges. Building reliable networks in space is complex. Maintaining them is expensive, and competition will likely increase as the opportunity becomes more visible. This is why outcomes will vary. Some companies may succeed by focusing on efficiency. Others may succeed by specializing in a narrow function, and some may struggle to translate early momentum into sustainable operations. That variation is not a weakness of the system. It is how systems evolve. Over time, the market tends to reward businesses that combine three things: a clear role within the ecosystem, the ability to execute consistently, and a financial structure that can support long-term growth. When these elements align, value tends to follow. When they do not, even strong narratives can fade. This is where expectations need to remain grounded. It is easy to look at a developing industry and imagine a straight path forward. But real progress is rarely linear. It moves in phases: growth, correction, adjustment, and then growth again. Each phase reveals different information. Periods of optimism show what is possible. Periods of correction show what is realistic. Both are necessary. A balanced perspective does not try to predict every movement. Instead, it focuses on understanding the direction and recognizing that the path will be uneven. This mindset also helps manage one of the more subtle risks in markets: the pressure to act simply because something feels important. High-profile events create a sense of urgency. They make it seem like timing is everything. But in many cases, timing matters less than understanding. Acting without clarity can lead to decisions driven by emotion rather than logic. Waiting for clarity does not guarantee better outcomes, but it does reduce the likelihood of reacting to noise. And in complex developing industries, reducing noise is often more valuable than chasing signals. Another useful way to frame this is to think about optionality. In uncertain environments, maintaining flexibility can be as important as making a specific choice. Keeping the ability to observe, adjust, and respond over time allows decisions to be informed by new information. This is particularly relevant in sectors where timelines are long and outcomes are still forming, because the most important developments may not be visible immediately. They may appear gradually through consistent execution, improving economics, and growing adoption. Those signals are easy to miss if attention is focused only on major announcements, which brings the discussion back to where it started. A single company, no matter how influential, does not define an entire industry. It can shape it, it can accelerate it, it can even lead it for a period of time. But the full picture is always broader. The real opportunity, if it exists, is not in predicting a single outcome. It is in understanding the system well enough to recognize where durable value is being created. That requires patience. It requires a willingness to look past short-term excitement. And it requires focusing on how things work, not just how they are presented. If those elements are in place, then moments of heightened attention can be useful, not as signals to act quickly, but as prompts to think more deeply, because in the end, the goal is not to follow the story, it is to understand the structure behind it. If this helped clarify the way you think about emerging industries, a like and a subscription helps this message reach others who are trying to make sense of complex markets. The focus here is always on understanding patterns, improving decision-making, and building a more grounded view over time.